The history of money from barter to Bitcoin. Imagine waking up tomorrow and discovering that every bank account, every wallet, and every payment app had disappeared overnight. How do you buy food? How do you pay rent? How would businesses survive? Money is so deeply embedded in our daily lives that most people rarely stop to ask a fascinating question: how did humanity create money in the first place? The story of money is not merely an economic story. It is a story of trust, innovation, power, trade, and human civilization itself. From ancient farmers exchanging livestock to modern investors trading digital currencies worth billions of dollars, money has continuously evolved to solve one fundamental challenge: making exchange easier and more efficient. In today's journey, we will travel through thousands of years of human history, exploring how societies moved from barter systems to metal coins, paper notes, banks, credit cards, online payments, and finally to decentralized cryptocurrencies such as Bitcoin. By the end of this video, you will understand why money exists, why it keeps changing, and what its future might look like in an increasingly digital world. Let's begin our journey. Point number one: the world before money, the barter system. Long before banks existed, before governments printed notes, and before gold became valuable, human societies depended on a single method known as barter. Barter refers to the direct exchange of goods and services between two individuals without using any medium of exchange. In prehistoric communities, people were often self-sufficient. Families hunted animals, cultivated crops, made clothing, and built shelters using available resources. However, as communities expanded and individuals specialized in certain skills, exchanging goods became necessary. A farmer who produced wheat needed tools made by a blacksmith. A fisherman required clothing stitched by a tailor. Instead of paying with money, they exchanged products directly. At first glance, barter appears straightforward and practical. However, it contained significant limitations that hindered economic growth. Economists describe one major challenge as the double coincidence of wants. This means both individuals must simultaneously desire what the other person possesses. Suppose a fisherman wanted rice, the farmer might not need fish but instead acquire firewood. The fisherman would then need to find someone willing to exchange firewood for fish before obtaining rice. This process was inefficient and time consuming. Barter also created difficulties in determining value. How many baskets of apples equal one goat? How many chickens are worth repairing a roof? Different communities established their own standards, often leading to disagreements. Another problem involved storage. Perishable goods spoiled quickly, making wealth preservation difficult. Economic expansion requires systems that support larger populations and distant trade. Barter struggled to meet these demands. Over time, societies searched for objects universally accepted as valuable. This search laid the foundation for the invention of money. Let's say example. Imagine Sarah wants 10 chickens and wants new pair of shoes. The shoemaker does not need chickens because he already has plenty. Instead, he wants wool. Sarah must first locate a shepherd willing to trade wool for chickens and then exchange the wool for shoes. This complicated process illustrates why civilizations sought better alternatives. Barter represented humanity's first economic achievement, but it was only the beginning of a much larger story. Next point number two: commodity money. When objects became currency, as civilization grew larger and trade routes expanded, societies began using certain commodities as money. Commodity money possesses intrinsic value because it can be consumed, utilized, or appreciated independently of its monetary role. Various cultures selected different commodities based on local availability and social significance. Salt served as money in ancient Africa and parts of Europe. Cowrie shells circulated widely across Asia and Africa. Cattle symbolized wealth in numerous pastoral societies. Tobacco functioned as currency in colonial America. Tea bricks were exchanged in Central Asia. These items succeeded because communities collectively agreed they held value. Commodity money solved many barter problems. People no longer needed to find someone who wanted exactly what they possessed. Instead, individuals accepted commodities knowing others would also recognize their worth. However, commodity money introduced new challenges. Transporting livestock over long distances were inconvenient. Salt could dissolve. Food products deteriorated. Sales varied in quality and quantity. Large transactions remained difficult. Despite these shortcomings, commodity money represented as a revolutionary advancement because it introduced the critical concept of universally accepted medium of exchange. Perhaps more importantly, it demonstrated that money derives much of its power from social trust rather than physical properties alone. Let's say example. In ancient trading communities, a merchant selling pottery might accept cowrie shells from customers even if he had no immediate use for them. He tested that other merchants would later accept their sales in exchange for grain, fabric, or tools. That shared confidence transformed ordinary sales into functional money. Commodity money marked humanity's first major step toward organized economic systems and prepared societies for an even more durable and efficient innovation metal currency. Next point number 3, the age of metal coins. Money gets a standardized form. As trade expanded across cities, kingdoms, and continents, people needed a form of money that was durable, portable, and easy to measure. Commodity money had solved some problems, but it was still inconsistent and difficult to transport. This led civilization to discover one of the greatest financial innovations in history: metal coins. Metals such as copper, bronze, silver, and gold possessed several qualities that made them ideal for use as money. They were scarce enough to maintain value, durable enough to last for centuries, divisible into smaller units, and relatively easy to transport compared to livestock or sacks of grain. Historians believe the first standardized metal coins appeared around 600 BCE in the ancient kingdom of Lidal, located in present-day Turkey. These coins were made from electrum, a natural alloy of gold and silver, and were stamped with the official symbols by the ruling authority. The introduction of coins transformed commerce. Instead of weighing precious metals for every transaction, merchants could trust that the government-issued coin already represented a specific amount of value. This significantly reduced disputes and improved efficiency. Coins also strengthened governments, rulers, controlled minting, regulated the purity of metals, and collected taxes from more effectively. A kingdom's currency became a symbol of its power, stability, and economic influence. As the empires expanded, their currencies spread with them. The Roman Empire's silver denier circulated throughout Europe, North Africa, and parts of the Middle East. Similarly, Chinese dynasties developed bronze coins with square holes, making them easy to carry on strings. Metal coins encouraged long-distance trade because merchants traveling thousands of kilometers could use widely recognized currencies. Trade networks flourished, connecting diverse cultures and stimulating economic growth. However, metal coins were not perfect. Transporting large amounts of gold and silver remained risky. Coins could be clipped, melted down, or counterfeit. Governments facing financial crisis sometimes reduced the precious metal content of coins while keeping their face value unchanged. Despite these limitations, coins represented a major leap in financial history because they established the principle of standardized value backed by authority. Money was gradually evolving from objects with inherent usefulness into symbols whose value depended increasingly on trust and acceptance. Such as, imagine a merchant in ancient Rome selling olive oil. Instead of accepting goats, wheat, or cells, he simply receives silver coins bearing the emperor's seal. He trusts that anyone in the empire will recognize and accept those coins. Trade becomes faster, safer, and more predictable. Metal coins laid the foundation for global commerce and prepared humanity for an even more transformative development. Precious metal standards on the paper money. Next, point number 4, gold and silver, the precious metal standard. As civilizations became wealthier, gold and silver emerged as the preferred forms of money. These metals possessed unique characteristics that distinguished them from other commodities. They were rare, beautiful, resistant to corrosion, easily divisible, and widely admired across cultures. For thousands of years, gold symbolized wealth, prestige, and stability. Kings stored gold reserves to demonstrate their power, while merchants accumulated gold as a reliable store of value. Many countries eventually adopted the gold standard, a monetary system in which paper currency could be exchanged for a fixed amount of gold held by the government or central bank. The gold standard offered several advantages. It limited excessive money printing because governments needed sufficient gold reserves to support their currencies. This helped maintain price stability and encouraged confidence among the traders and investors. International trade also became easier because currencies were linked through their gold values. Exchange rates remained relatively stable, facilitating global business activities. However, the gold standard imposed significant constraints. Economic growth depended partially on discovering new gold supplies. During recessions, governments struggled to increase the money supply because they could not simply print additional currency without obtaining more gold. Major events such as wars and financial crises exposed these weaknesses. Governments often suspended gold convertibility to finance military expenditure or stimulate struggling economics. During the 20th century, many nations gradually abandoned the gold standard. Following global economic disruptions and changing financial needs, modern currencies evolved into fiat money. Money whose value is based primarily on government authority and public trust rather than physical commodities. Even today, gold remains highly respected as a safe haven asset during periods of uncertainty. Investors continue purchasing gold to protect wealth from inflation, geopolitical tensions, and market volatility. Gold's long history demonstrates an important lesson. Money functions effectively not simply because of its material composition, but because societies collectively believe in its value. Let's say, suppose a banknote in 19th century stated that it could be exchanged for a certain amount of gold. A person holding that note trusted its value because they know could they could visit a bank and receive actual gold in return. That convertibility created confidence in the monetary system. Gold and silver shaped economics for centuries, but carrying large quantities of precious metals remained inconvenient. The next chapter in the story of money introduced a lightweight innovation that would revolutionize finance forever. Paper currency. Next point number 5. The birth of paper currency from promises to powerful currencies. The invention of paper money was one of the most revolutionary moments in financial history. For thousands of years, people relied on heavy metal coins made of gold, silver, and copper. While these coins were valuable, carrying large quantities over long distance was inconvenient, expensive, and dangerous. Merchants traveling across continents facing the constant risk of theft, loss, and transportation difficulties as trade networks expanded. Societies needed a lighter and more practical alternative. The earliest known use of paper money emerged in China during the Tang dynasty around the 7th century. Merchants conducting the long distance trade often deposited their coins with trust agents and received paper receipts in return. These receipts could later be redeemed for the deposited coins. Over time, people began accepting these receipts directly as payment because they trusted the issuing authority. During the Song dynasty, the Chinese government officially introduced paper banknotes, making China the first civilization to establish state-issued paper currency. Paper money offered remarkable advantages. It was lightweight, easy to carry, simple to store, and suitable for large transactions. Governments found it easier to finance infrastructure projects, military campaigns, and economic activities by issuing currency rather than transporting tons of precious metals. Paper money facilitated domestic commerce and encouraged international trade, contributing significantly to economic growth. Despite these benefits, paper money introduced new challenges. Unlike gold and silver, paper possessed little intrinsic value. Its worth depended entirely on trust in the issuing authority. If governments printed excessive amounts of currency without sufficient economic support, inflation could erode purchasing power. Historical examples from various countries demonstrate how uncontrolled money printing can destabilize economies and diminish public confidence. Europe adopted paper money much later. During the 17th century, banks and governments in countries such as Sweden and England began issuing banknotes that represented claims on precious metals stored in wallets. Over time, these notes evolved into modern fiat currencies whose value derives primarily from government backing and societal acceptance. Today, paper money remains widely used, although digital payments increasingly dominate everyday transactions. Nevertheless, the underlying principle remains unchanged. Paper currency functions because people collectively trust that it will be accepted tomorrow just as it is accepted today. Imagine a merchant in ancient China preparing for the month-long journey carrying silk worth thousands of silver coins. Instead of transporting heavy bags of metal, he deposited his coins with a trusted institution and receives a paper certificate. Along his journey, other traders willingly accept the certificate because they know it can be exchanged for silver. This simple innovation dramatically improves efficiency, safety, and convenience. Paper money demonstrated that money's true power lies not in the material itself, but in the shared belief that it represents value. This realization paved the way for the emergence of banking institutions and the modern financial systems. Next, point number 6. The rise of banks, cheques, and modern finance. As commerce expanded and societies became increasingly interconnected, managing wealth required institutions capable of storing money securely, facilitating transactions, and providing financial services. This necessity led to the development of banks, which would eventually become the backbone of modern economies. The earliest banking activities can be traced to ancient Mesopotamia, where temples safeguarded grain deposits and precious metals. However, modern banking began taking shape during the Renaissance period in Europe, particularly in Italian cities such as Florence and Venice and Geneva. Wealthy merchant families established financial houses that accepted deposits, extended loans, financed trade expeditions, and enabled international commerce. Banks offered a significant advantages to individuals and businesses. People no longer needed to hide gold in their homes or transport large sums of money while traveling. Depositors entrusted their wealth to banks, receiving documentation proving ownership. This increased security, encouraged saving and investment, fueling economic development. One important innovation introduced by banks was the check. A check is essentially a written instruction directing a bank to transfer a specified amount of money from one account to another. Checks reduced the need to carry physical cash and simplified business transactions. Merchants could settle substantial payments through paperwork rather than transporting coins or banknotes. Banks also introduced lending on a large scale. Businesses borrowed capital to expand operations, governments financed infrastructure projects, and enterprises transformed ideas into thriving enterprises. Access to credit accelerated industrialization, technological advancement, and global trade. As banking system evolved, central banks emerged to oversee monetary policy, regulate financial institutions, and maintain economic stability. Central banks manage inflation, influence interest rates, and act as lenders of last resort during financial crisis. Their role became especially important during periods of economic uncertainty. However, banking systems have also faced challenges. Financial panics, bank failures, fraud, and economic recessions have periodically undermined public confidence. These events prompted governments to implement regulations designed to protect consumers and strengthen financial stability. The rise of banks fundamentally changed humanity's relationship with money. Wealth increasingly existed not merely as physical objects but as entries recorded in ledgers and account statements. Money was gradually becoming more abstract, moving away from tangible assets toward systems built on trust, institutions, and technology. It's an example. Consider a textile merchant in 18th century England who wishes to purchase cotton from overseas suppliers instead of carrying thousands of pounds in cash. He writes a check instructing his bank to transfer funds to the seller. The supplier accepts the check because he trusts the banking institution behind it. The transaction is faster, safer, and more efficient than transporting physical currency. Banks transformed money from a simple exchange tool into a sophisticated financial system capable of supporting global trade and investment and economic growth. This evolution prepared the world for the next major leap: electronic payments, credit cards, and the digital revolution. Next, point number 7: credit cards and electronic payments. Money becomes invisible. By the middle of 20th century, economics were growing rapidly, international travel was becoming more common, and consumers were demanding faster and more convenient ways to pay for goods and services. Carrying large amounts of cash was inconvenient and risky. While checks required time to process, the world was ready for another transformation in the history of money: electronic payments. The modern credit card was introduced in 1950s. One of the earliest successful examples was the Diners Club card, which allowed customers to pay for restaurant meals without carrying cash. Soon afterward, banks began issuing credit cards and that enabled consumers to purchase goods immediately and repay the amount later. This innovation changed spending habits and expanded access to short-term credit. Credit cards offered several advantages. They improved convenience, reduced the need to carry physical cash, provided fraud protection, and created opportunities for consumers to build credit histories. Businesses benefited because customers were often willing to spend more when payments were easy and immediate. Technological advancements accelerated the shift toward electronic transactions. Magnetic stripes, chip technologies, contactless payments, and online processing systems made transactions faster and more secure. Debit cards connected directly to bank accounts, allowing users to spend their own money electronically. Electronic payments transformed the retail industries, hospitality, businesses, transportation systems, and global commerce. Consumers could purchase products from different countries with a simple swipe, tap, or click. Businesses gained access to broader customer bases and more efficient accounting systems. However, electronic payments also introduced concerns about cybersecurity, identity theft, overspending, and increasing dependence on digital infrastructure. Financial literacy became increasingly important as consumers gained easier access to borrowing and spending. Despite these challenges, electronic payments represented a major milestone because money was becoming less tangible. People no longer needed to physically hold coins or banknotes to participate in economic activities. Wealth increasingly existed as digital records stored in banking systems. This shift fundamentally changed how societies perceived money. For many younger generations, the idea of carrying large amounts of has become almost outdated. Example, imagine a traveler arriving in another country with only a credit card in their wallet. They can book a hotel, purchase meals, rent a car, and shop at local stores without exchanging physical currency. What once required bags of coins or stacks of paper notes can now be accomplished with a small plastic card. Electronic payments demonstrated that convenience and trust in financial system could gradually replace the need for physical money. Next point number 8, internet banking, mobile payments, and the FinTech revolution. The arrival of the internet in the late 20th century reshaped nearly every aspect of modern life, and money was no exception. Banking institutions quickly recognized the potential of digital technology to improve customer experience and reduce operational cost. Internet banking allowed customers to access their accounts from home computers. People could check balances, transfer funds, pay bills, and monitor transactions without visiting a physical branch. This convenience appealed to busy individuals and businesses seeking greater efficiency. As smartphones became widespread, mobile banking applications revolutionized financial services even further. Users could send money instantly, scan QR codes for payments, and manage investments from virtually anywhere in the world. The rise of financial technology companies, commonly known as FinTech firms, accelerated innovation. These companies challenged traditional banking models by offering user-friendly platforms, lower fees, and specialized services tailored to modern consumers. The digital wallets became increasingly popular. Instead of carrying physical cards, users stored payment information securely on their smartphones or wearable devices. Contactless transactions reduced checkout times and improved customer experiences. Pay-to-pay payment platforms enabled friends and family members to transfer money within seconds. Small businesses benefited from affordable digital payment solutions that expanded their customer reach. FinTech innovations also improved financial inclusion. Millions of people without access to traditional banks gained opportunities to save money, make payments, and participate in economic activities through mobile financial services. Nevertheless, digital finance depends heavily on internet connectivity, cybersecurity measures, and technological infrastructure. Data privacy concerns and fraud prevention remain critical priorities for governments and businesses and consumers. The FinTech revolution highlights an important trend in monetary evolution. Money is becoming increasingly integrated with technology. Physical boundaries matter less, and transactions can occur almost instantly across continents. Let's say example, consider a college student studying abroad who needs emergency funds. Instead of waiting several days for an international bank transfer, a family member can send money instantly through a mobile payment application. Within minutes, the student can access the funds and continue daily activities without interruption. Internet banking and FinTech innovations brought unprecedented convenience, but an even more radical idea was emerging, a form of money that operates independently of governments and banks. Point number 9, Bitcoin and blockchain, the birth of decentralized money. In 2008, during a global financial crisis that severely damaged trust in traditional banking institutions, and individual or group using the pseudonym Satoshi Nakamoto introduced a revolutionary concept, Bitcoin. Bitcoin was designed as a decentralized digital currency that allows users to send and receive payments without relying on banks, governments, or other intermediaries. The system is powered by blockchain technology, a distributed digital ledger that records transactions across thousands of computers worldwide. Blockchain works by grouping transactions into blocks that are linked chronologically. Once information is recorded on the blockchain, altering it becomes extremely difficult, providing transparency and security. Unlike traditional currencies, Bitcoin has a limited supply. Only 21 million Bitcoins will ever exist. Supporters argue that this scarcity protects Bitcoin from inflation caused by excessive money creation. Bitcoin offers several advantages. Transactions can occur globally without requiring permission from financial institutions. Users maintain direct control over their assets through digital wallets. Blockchain technology reduces reliance on centralized authorities and promotes transparency. However, Bitcoin also faces criticism. Its price is highly volatile, making it challenging to use as a stable medium of exchange. Regulatory uncertainty Cybersecurity risk and environmental concerns associated with the cryptocurrency mining remain significant issues. Despite these challenges, Bitcoin inspired the development of thousands of other cryptocurrencies and blockchain-based applications. Governments, banks, and corporations are actively studying how blockchain technology can improve financial system. Bitcoin's emergence raises profound questions about the nature of money. If societies once accepted cells, gold, paper notes, and digital bank balances as money, could decentralized digital assets become the next stage in monetary evolution? Let's say example. Suppose a freelancer graphic designer in Brazil completes a project for a client in Germany. Instead of waiting several days for an international bank transfer and paying substantial fees, the client sends Bitcoin directly to the designer digital wallet. Within minutes, the payment is received and verified by the blockchain network. Bitcoin demonstrates that technological innovation continues to challenge traditional assumptions about money and financial system. Next, point number 10. The future of money, cashless societies, central bank digital currencies, and AI payments. The history of money shows a consistent pattern. Societies adopt new forms of money when they offer greater convenience and security, efficiency, and trust. Today, humanity may be entering another significant chapter in this ongoing journey. Many countries are moving toward cashless economics where digital payments dominate everyday transactions. Consumers increasingly use smartphones, smartwatches, biometric authentication, and online platforms instead of physical banknotes. Governments worldwide are exploring central bank digital currencies, often called CBDCs. Unlike cryptocurrencies, CBDCs are digital versions of national currencies issued and regulated by central banks. These systems aim to combine the efficiency of digital payments with the stability of government-backed money. AI is also influencing the future of finance. AI-powered systems can detect fraudulent activities, personalize financial advice, automate budgeting, and improve payment security. Emerging technologies may eventually enable autonomous transaction between machines. Smart refrigerators could record groceries automatically. Electric vehicles might pay charging stations independently, and smart contracts could execute agreements without human intervention. However, the future of money raises important ethical and social questions. How can societies protect privacy? Will digital systems exclude individuals without technological access? How can governments balance innovation with regulation? History suggests that money will continue evolving because human needs, technologies, and economic systems constantly change. The form of money may transform, but its essential purpose remains unchanged, facilitating exchange, storing value, and enabling cooperation among people. Let's say, example, imagine waking up in 2040. Your AI assistant notices that your utility bill is due, verifies your budgets, or authorizes payment using a government issued digital currency, and records the transaction automatically, all before you finish breakfast. Whether money exists as a paper itself or something entirely new, one principle will remain timeless. Money works because people trust it. Finally, from trading goats for grain to transferring Bitcoin across continents in minutes, the story of money is ultimately the story of human ingenuity. Every stage, from barter and metal coins to banks, credit cards, fintech, and cryptocurrencies, reflects humanity's constant effort to make trade easier, safer, and more efficient. Money is not simply paper, metal, or computer code. It is shared agreement, a symbol of trust, and one of civilization's most powerful inventions. And as technology continues to reshape our world, one fascinating question remains: what will be the next chapter in the history of money? If you enjoyed this journey through evolution of money, don't forget to like, subscribe, and share your thoughts in the comments. Do you believe Bitcoin, AI powered currencies, or something entirely new will define the future of money? Let us know below, and we will see you in the next exploration of finance, history, and innovation. Thank you.